invested in fixed term deposits, mutual funds, and real estate. That's great diversification, right? Well, it's good, but it can be better. You see, fixed term deposits and mutual funds, which are essentially debt in equity holdings in government and businesses, are financial assets, which means that they go up and down with the rumblings of the financial market. And real estate is real, that is tangible, but lumpy. And you are living in it, right? So you're not selling that in a hurry. So how else can you diversify? Yes, gold is one way, but gold is a special case. Gold was used as a currency before the prevalence of paper. Because of its scarcity value, it has held its value against inflation over the long term. It's also done well when financial markets have not. But apart from being a currency, did you know gold is also a commodity? Commodity is basically a natural asset which can be grown, mined, or extracted from the earth. You can invest in a range of other commodities to hedge against inflation and diversify your portfolio. There are three broad categories of commodities. Metals. Precious metals like gold, silver, platinum, or industrial metals like aluminium, copper. Energy. Crude oil or natural gas. Agriculture. Edible crops like coffee, sugar, corn, wheat, or materials like cotton, jute. Given that there are more than 7 billion people on Earth who will consume products made from these raw material commodities, you can be always assured that there is demand for them. The question is, how will the demand and supply balance out, and how that will impact prices over the long term? I think it's prudent to get exposure to commodities because you can be rest assured that you'll be using them. Next question is, how will you get that exposure? There are a few different ways. First is physical holding. You can do that with things like gold, but not really with things like oil or wheat, right? Not feasible. Second is commodity-related stocks. So these are the equity stakes of companies that grow, mine, or provide infrastructure to those commodities. But here's the thing. Either they actually hedge out their exposure to commodities, or two, the prices of those stocks fluctuate with the stock market, so you've achieved no diversification. Third is ETFs or mutual funds. So there are some gold ETFs or exchange-traded funds, but there aren't any other commodity-related ones. The fourth is commodity derivatives. This is the most common way investors get exposure to the commodities market. There are two types of derivatives: futures and options. A futures contract is basically a forward contract in which the producer agrees to sell at a preset price and delivers the produce at a preset date. That contract has to happen. There's an obligation. On the other hand, an option gives you the right but not the obligation to deliver. You must be wondering, if commodity prices are also listed on exchanges, surely their prices fluctuate as much as stocks. Yes, they do, but not by as much, and more importantly, not at the same time. Why? Because a lot of institutional investors like mutual funds, pension funds, and hedge funds trade in the commodity market to implement their views on the economy. They do so with the help of specialist commodity traders who ensure that the price of commodity futures reflects the demand and supply of the underlying commodity, which is a tangible asset, remember? Institutional investors may also look at the relative prices in the commodity market to gauge the health of the economy and the supply chain of that commodity. For example, if they see the prices of copper going up, they may know that the economy is doing well because copper is an industrial metal. On the other hand, if copper prices are not doing well, people may want to invest in gold. So, in summary, commodities is an asset class that is useful to diversify your portfolio from financial assets like debt and equity, and also from real estate. There are three broad categories of commodities: metals, energy, and agriculture. You can also invest in commodities via commodity ETFs or commodity derivatives. Derivatives reflect the market sentiment usually more accurately than financial markets because they reflect the demand and supply of the underlying tangible commodity. You may want to learn more online or ask your financial advisor.